Today we have a paper by Dr. Xiaoming Ding and Dr. Kyung Jai and myself. So let me have the pleasure of introducing Dr. Xiaoming Ding, who is an associate professor of accounting finance at Jiaotong-Liverpool University in China. He received his MSc in accounting and finance, MSc in computer science, and PhD in finance from the University of Birmingham. At the moment, he's undertaking a lot of research involving deep learning and machine learning applications in broad areas of finance. He's also principal investigator of two large projects. One is the Jianshu Social Science Fund project on venture capital syndication and internationalization, evidence from Jiangshu. He's also the principal investigator of a project on the status of Suzhou venture capital industry and policy implications, funded by the Suzhou Social Science Applied Research Funding Program. Dr. Xiong Jie is a doctoral fellow, also working with the Dr. Xiaoming Ding. And myself, I've already introduced myself. This is a part of a large research project, which is headed by Xiaoming Ding and involving the three of us on looking at the venture capital in China and in a global setting. This is one of a couple of papers that we have so far produced, and some of the papers on the Center for Global Finance website. Okay, so the venture capital industry is a big industry globally. I remember, and I want to thank colleagues previously at Birmingham, Ranko Jerick, now University of Surrey, University of Sussex, and Wasim, still at the University of Birmingham, who introduced me to venture capital years back. And we did a couple of papers to look at the venture capital industry in the UK and the financing of firms, and the staying power of venture capital in firm financing in the UK, and of course extending collaboration with the other firms that are funded through London. But the motivation for this particular paper arises from the role of institutional investors and how venture capital firms come into to play a role here. And the literature, especially starting by the work of Edmonds and Holdens in 2017 in Journal of Finance, mentioned that institutional investors are increasingly important in firms' ownership structures across many countries, and are likely to be very active in the firm governance of many firms around the world. Okay, they basically, call the shots, and they may also influence CEO power, the power of the CEO. However, the empirical work on the impact of institutional ownership or institutional investors is rather mixed. One strand of literature said, well, they bring in key information to investors, and especially the work of Hatzer and Starks 2003, just to bring in the work of accurate information sharing to investors. But Adamant 1994, which is many years back, really brought to the fore the role of these institutional investors playing a monitoring role. They are, in the words of Klaus Wilhelm, just a policeman on the end, trying to monitor what is happening among the companies. And the work of Pound earlier on brings in their role as basically bringing some activism to influence the policies that firms adopt. And of course, the other work by Perino brings in that the fact is basically they play an important role. They could move. And if they leave the company, then there will be a problem with the share price. So they vote with their feet. In fact, only two studies, the one by Levinson 2003, Journal of Financial Economics, and Richardson 2016, the Review of Finance, are closely related to the work that we are sharing with you today. And they are strictly looking at US firms, and they do not incorporate some of the factors that we incorporate in our study today. We need to be able to appreciate that all these institutional investors, they differ in the way they get involved in the corporate governance activities. And because of those differences in the way they're involved, the effects on the, for example, the investment behavior of these firms will vary across the institutional types involved in this process. And globally, we need to appreciate that the institutional owners are really a large component. And if we take, say, and the data source we used here is, say, is Wind, the major data source on venture capital in China. Looking across the world, you find that basically you have high institutional ownership percentages, high about 60 in the US, the same in Canada, low at about 39% in the UK. And then, of course, different variations across the countries. But in these sample countries, really the institutional ownership is high, okay? And there are reasons why. Now, China is based somewhere here at about 30%, a high percentage, but within this, the top heavy institutional owners in farm ownership across the world. What this tells us from the emphasis on why venture capital among the institutional investors, because venture capital have this characteristic of being able to stay. This is the staying power. They invest in firms when they are startups. They continue to hold ownership even after the initial public offerings. Okay, so they have a life affiliation with these firms. However, the work of Fred way back in 1998, brought out the fact that they are high risk and high return nature. Of course, they require reassurance that the resources are being put to their best advantage. And they then can exit maybe at the level of IPO. The IPO seems to be the most profitable exit mechanism for venture capital firms. But we also have to appreciate some of the benefits they bring to corporate growth. The first, of course, is that they help the firm obtain alternative further sources of equity financing, as well as debt financing. This fact is very much recognized even in the economic, the ECA, the Economic Commission for Africa UN report 2020, in which a group of us were involved. They actually mentioned the role of innovative financing, and especially for Africa, the need of expanding venture capital. So there's common elements here of the role that they play, which otherwise will not happen. But in particular, the work of Gombas brings out the role of monitoring. And because of that, we might expect that venture capital firms are able to enhance the investment efficiency of portfolio firms by bringing in information, by bringing in other investors, and by monitoring. So really the research question that arises from this is how and whether and how venture capital impacts the investment efficiency of the portfolio firms. does really improve the efficiency of portfolio firms? And if so, how does this happen in terms of the mechanism? And that's the fundamental question at the back of this paper. Why focus on China? We focus on China because at the moment the growth of venture capital market the growth is second largest in the world, systemic analysis on this remains very, very limited, in spite of the fact that that's the market that is growing extremely fast. It is also growing, we understand, because the China government plays a vital role in the business activities through its majority ownership in state-owned enterprises. And this argument is consistent with the work of a colleague in the audience, Professor Hongbo, who works on this in this area. So, so the state ownership is important here, and the government policy in China is important because that's likely to influence how the Chinese state-owned enterprise corporate policies play. Of course, there is another additional reason why this paper should focus on China, because as Franklin Aren and others said in the paper 2005, China has always been regarded as a counterexample to the findings of existing literature whenever you look at economic growth, economics and growth in the rest of the world. China is regarded as a counterexample that we be able to put on the table or uncover results which may even be a departure from neoclassical findings. So in terms of the contributions, this paper delivers a number of contributions. In the first instance, the paper fills an important gap in the literature on the debate of the financial implications of venture capital involvement in corporate investment efficiency. But in addition, it is a very important way of trying to explain how the financial side of the economy, especially driven by corporate finance, relates to the real side of the economy in terms of production, output, and others. And an important element there, of course, is the role of venture capital and farm financing and farm ownership. But importantly, number three, this paper will produce a new evidence by basically being able to pin down the factors that influence investment efficiency and which are still a factor of which are still a point of further investigation in existing research. The focus on China, finally the focus on China is part of the focus on emerging markets where evidence has been limited and where we need to be able to explore more evidence and mechanisms regarding the strategic role of institutional investors, and in particular venture capital, on farm investment dynamics. The literature, I have highlighted some of this, so let me go and cover this element of what do we know in the literature, what is the existing state of knowledge according to existing research. I just want to selectively highlight a couple of strands of literature that motivate or are important to this particular paper, and try to use this literature to formulate some hypotheses, some plausible hypotheses, theoretically tractable hypotheses that we then later investigate or econometrically in the paper. I think the first important strand of literature relates to the finance theory on agency problem, the principal agent problem, and information asymmetry, and how these affect investment efficiency of firms. And this is the tradition in the RW tradition of economics and finance, revolves from the neoclassical framework of saying, well, you have firms, okay, and the owners of the firm are the principals, the CEO and top management are the agents, and principal agents problems occur if, of course, there is, part of a departure between what the principals think can do and what the agents think can do. But in particular, in this neoclassical framework, the important consideration is what we know technically as Tobin's Q. Okay. And the argument here is that a firm's investment should be solely determined, mainly determined, by the profitability of investment as measured by Tobin's Q. So firms invest until the marginal benefits of capital investment equal the marginal cost. And this goes to the real foundation of finance. Finance is a young discipline, as you know. Some of us may be older than finance. Finance really hacks in the paper of Modiglian and Mira in 1958. You had a lot of economics tradition, but finance becomes a distinct subject. And in this real the theoretical foundation of finance in Modiglian and Mira 1958 paper, this is the emphasizes the neoclassical tradition of firms' investment and the maximization arguments in which firms invest until the marginal benefits of capital investment equal the marginal cost. Okay. However, as you know, this neoclassical theoretical foundation is built on a number of so many simplifying assumptions. Okay. And what we've been doing in the last, say, more than 50 years is basically to re-examine some of these assumptions and be able to come up with the shed more light on what we know from the in the many years that finance has been studied as a distinct discipline. For example, we know that if we relax the assumptions of that the assumption that information is freely available and costlessly so. Okay. So we know that there might be a number of frictions and distortions, for example, government taxes, government involvement, and these frictions and distortional forces may prevent firms from making investment optimally. Even, by the way, even in the real options model, the current form of guiding investment, this is an important consideration of the distortion forces of why firms invest. So, but it is also recognized that there is a problem of information asymmetry. And I think the work of Fazari and others is particularly important in 1988, whereby they show, and I should say also the work of Hongbo in the last couple of years is important, in showing that the external financing constraints force firms to reduce feasible investment, and that results in underinvestments. So firms are not able to invest fully the amount they would want to invest. Okay, that's underinvestment. However, Schleif and Vichier, in their global work, they do all these, doing stuff around the world. They then uncover a counter problem, a competing problem of overinvestment. Why do firms overinvest? And Schleif and Vichier take up one of the neoclassical tenets of agency costs, the principal agent problem. And they say the management engaging in additional investments on self-serving projects for empire building may result in overinvestment. Okay. And so we have a case whereby, because when we take into account agency problems and information asymmetry, firms may overinvest, firms may underinvest. Okay. So that's an important consideration. But of course, firms have long-term capital commitments, and this is where venture capital comes in. Venture capital enables these firms to have long-term commitment, okay, so that shareholders can focus on value creation on the portfolio firms in which the venture capital firms invest. Those are the portfolio firms. And the venture capital firms apply additional capital for firm growth as Inright and others mentioned 2007. So you could argue that firms which are backed by venture capital institutions have better information quality, as Amit uncovers in 1998, or also have higher firm value, as Kroc and others 2013 uncover, or have reduced agency conflicts, as Sorensen 2007 uncovers, or have lower financial constraints, as Dan Rin 2013 paper uncovers. And these lead to reduced information asymmetry and agency problems. And the reduction of those problems, of course, would increase investment efficiency. So this is a finding to say venture capital will increase the efficiency of investment by the firms in which venture capital is playing a leading role. However, these set of results are at variance, are at conflict with what some other researchers have found, especially Lee and War, who found that conflicts of interest and coalitions might force venture capital firms to pursue private benefits. And this may intensify information asymmetry and agency problems, and this may lower investment efficiency. So on the basis of existing knowledge, we have now counter evidence. One saying that venture capital ownership will increase investment efficiency, and another solid set of evidence saying venture capital will lower investment efficiency. So based on this, we formulate our first hypothesis, which is that venture capital ownership enhances portfolio firms' investment in efficiency. Testing for this would confirm, and if of course, the other alternative hypothesis, of course, would be that it would lower information efficiency. So we want to formulate this hypothesis to be able to subject this to empirical scrutiny. We then touch on a second strand of literature, which looks much more critically on the role that information asymmetry plays in investment efficiency. Okay. And the argument actually goes back to the work of Rousseff. Rousseff has most of the work he was doing on information asymmetry, not only on cost of financing, but also on dividend policy. Rousseff argues that the cost of financing would be high when there is information asymmetry, and this is likely to occur to incur the monitoring of capital markets when firms must finance externally, obtain external financing rather than internal financing. Therefore, firms will more likely underinvest when facing negative cash flows. But further to this, the research by Lin and Fu in 2017 assures us that venture capital firms are very unique. They have capabilities of reducing information asymmetry because their superior managerial skills and substantial resources they put in when they're investing will enable them possess superior private information. And therefore, most likely, they will not be having any problems at all of igniting or achieving efficient investment. We then take this into account by taking into account the work by Brav and Gombas, which shows us that actually firms invested by venture capital can attract higher quality and more higher quality analysts and more firm investment because they have all the experience reduced information asymmetry and lower cost of external financing. So really in this literature, when we see the role of information asymmetry, on the basis of the leading papers and some of the recent papers we have so far, we are led to hypothesize that the positive impact of venture capital on investment efficiency may be realized through decreasing information asymmetry. So we formulate hypothesis number 2 to say that information asymmetry has a mediating effect on the relationship between venture capital and investment efficiency. And that's the role of information asymmetry, and of course how we measure it. And we shall subject this second hypothesis to empirical investigation. The third strand of literature we visit here is the literature that emphasizes the principal agent problem, but in terms of agency costs. Majlaf, as in Myers and Majlaf, the Majlaf paper of 1984, and the extension of this by Myers and Majlaf, show that firms' investment decisions are significantly affected by agency costs. But this is also further illustration by Georgian and Rugberg, who show that information efficiency is more severe for firms with higher agency costs, but institutional ownership enhances investment efficiency by actually effectively monitoring and reducing those costs, consistent with the earlier paper we mentioned by Shleiver and Vishnye. And we contextualize here venture capital as a kind of institutional investors. They actively monitor the portfolio firms, something that we have mentioned, and which is difficult for smaller or less informal investors to do, as the evidence in Hartzell and Stark's 2003 paper mentions. But venture capital firms are also different from other firms. They do not only provide equity financing, as we mentioned, but they also sometimes sit on the board of directors, which means they can play an important role in formulating policy, providing an extra window for monitoring the portfolio firms intensively and being actively involved in the majority of the firm's major policies and decisions. And that's quite well illustrated in the paper by Kaplan in 2003, an earlier paper by Salman in 1990, except that the monitoring mechanism in these two papers occur. But what we infer from this literature about addressing the issue of agency costs is that venture capital firms are expected to enhance the investment efficiency of portfolio firms through reduced agency costs, and especially the costs of monitoring. So we formulate hypothesis number 3, that agency costs have a mediating effect on the relationship between venture capital and investment efficiency. And so, basing on the existing literature, we are able to derive 3 main hypotheses that will be examined further in this paper. And now this presentation is a 2-person drama. So I will stop here and invite my co-authors. I invite Xiaoming to take over the presentation. Thank you.
Thank you, Victor. Can you hear me well?
Yes, we can hear you very well. Thank you. Please go ahead.
Okay, thank you. And I believe that another of our co-author is also online and taking the notes about the comments from the audience. So if you have any comments, you are welcome to send us the comments in the dialogue window, and then we'll respond at the end. Now let's start from the data part. The main data is from 2 sources. One source is mainly for the financial data for the firms, the ownership data as well. And it's from the SISMA. It's a well-known database for the Chinese listed firms. We collected the data from 2003 to 2016. Another source of the data is from the database called CV Source. The C and V stand for China Venture. And so basically it's one of the two major sources of Chinese venture capital firms. Another one is called Zero to IPO. But we compare these two data sources, and we believe that for most of the data, they are quite consistent. So we believe that we can use any one of them. But for some extreme cases, the CV source may provide more rich information. So we chose the CV source as our main source of information for the data of the venture capital industry. So in our final data set, we include 2,565 listed firms information, and among those 2,500 firms, 567 of them are the VC-backed firms, which means that if we take the percentage, about 22% of the firms, listed firms, they are backed by the VC industry. That's our data. So let's move forward to the summary statistics. Victor, I think we need to move on the slides. Right. We have the summary statistics on page 12. We have 3 panels here. Panel A of the table present the summary statistics of the full sample. On average, firms' annual investment expenditure is around 10%. And of course, if we use the adjusted investment, which is a percentage, it's a ratio, then it's about 119 if we compare to the industry median. And the figures are similar to Alvarez 2018. The average over investment are about 4%, and the under investment is about minus 2.9% if we take the minus as the indicator for the under investment. And we are still introducing the summary statistics, sorry. When we look at panel B and C, we represent the summary statistic for both VC-backed and non-VC-backed firms for our sample period. And we found that VC-backed firms in our sample, on average, they outperform the non-VC-backed firms in terms of investment efficiency. And that's consistent with the findings from Chen 2011, both 2 papers from Chen 2011. All right, let's move on. Here is our baseline regression model. We have the baseline regression model, and we have the introduction here in the table for our dependent variable and the main independent variable, which is the venture capital. So for the dependent variable, we have 2 measures, the investment expenditure and the ratio of the investment expenditure. And for venture capital, we use 2 main measures as well, the VC dummy or the VC ownership, which is a percentage. And of course, we also include variable, which is the usual variable for our measurement for investment opportunities, the Tobin's Q. We want to examine the relationship between the VC and investment efficiency. And to control for investment opportunities, we include Tobin's Q to measure the investment opportunity, like Vasari 1988. And the coefficient of the interaction between VC measure and Tobin's Q are used to test the relationship between VC ownership and the firm investment decisions. So if VC indeed provide the monitoring service and supervise the firms to make investment decisions, then beta 2 in this equation should be positive. And I think this is the, also we have the findings similar to the previous study as well. And we also try to replace the investment opportunity measurement with the annual growth rates in sales or annual growth rate in total assets. And both provide us the similar result. So we just report the result with the Tobin's Q in the following table 2. Here is the regression results for our basement model. And from the equation 1 to equation 4, those are the results for the dependent variable, which is measured by investment. And the equation number 5 to 8, they are measured by the adjusted investments. So we found that the coefficient on control variables, except for the VC variables and the Tobin's Q, and the coefficients of these control variables are generally consistent with the findings of the previous researchers, and the coefficients of Tobin's Q are positive and significant, indicating that more investment expenditures are associated with better investment opportunities. And these are the basic findings. We can see it from next page, page number 15. The basic findings from the baseline regression is that the coefficients of both VC dummy and VC ownership are positive and significant. And the coefficient 0.002 and 0.003 indicate that when Tobin's Q increase by 1 standard deviation, the investment expenditure is going to increase by 0.343% and by 0.65% more than non-VC backed firms. All right, and this result, we would like to highlight that this is consistent with the monitoring hypothesis. Now, the next page is about the underinvestment and the overinvestment. When we have the evidence, some initial evidence about the VC enhance the investment efficiency, but how the VC reduced the investment deviation from the expected level of investment. So in this case, we introduced the idea of the new investment, the expected new investment. So the firm-specific investment as a function of Tobin's Q and lag firm characteristics, which is used by Professor Gary Biddle, 2009, and Richardson, 2006. We believe that on page 17, we believe that for the firm's total investment, okay, it can be split into 2 components: the maintenance investment, including the depreciation and amortization, and on the right-hand side, the new investments, we would focus more on the new investments because it can be further divided into the expected investment on the projects and the abnormal investments. When we have the abnormal investments greater than 0, we believe that there is an overinvestment. When it's smaller than 0, we believe that there is an underinvestment. So here, when we have the similar to Richardson 2006, investment inefficiency is measured as the deviation from the expected investment. And we believe the fitting value from the equation from page 16 is the expected new investment. And the residue from that equation is the estimated of the abnormal investment, which could be overinvestment or could be underinvestment. All right. So on page 18, we presented the results, the regression results for overinvestment equation and the underinvestment equation. On the left-hand side, it's the overinvestment equation. On the right-hand side, 5 to 8, they are the underinvestment regression results. The results is briefly summarized on the next page. We have some initial findings as well. The coefficient, for example, the coefficient of the VC dummy and the VC ownership for underinvestment are significantly positive, indicating that the VC are able to reduce underinvestment. Because we are adopting the negative number here, so a positive coefficient is indicating the underinvestment will increase to 0 and indicating the better investment efficiency. So we may switch a little bit from the sign, the positive sign and the negative sign here. The coefficient of VC dummy and VC ownership for overinvestment are all negative, but they are not significant. VC are able to reduce the investment deviation from the expected level of investment, especially in terms of underinvestment. And again, this is in line with the hypothesis with the monitoring role of venture capital. Let's come to page 20. When we carry out the study, we noticed there might be some comments. There might be some arguments that the positive impact of the venture capital on investment efficiency in the previous session may have been influenced by omitted variables. Okay, and these omitted variables could be observable or unobservable, which impacting the investment efficiency. So also there is another potential issue, which is that VC may simply choose their firms with the higher investment efficiency to invest, which is the sample selection bias. All right. That's why we have this robustness session to check for 2 issues with Heckman's 2-stage approach and the 2-stage least square regression to address the potential sample selection bias and endogenous issues. On the next page, we have the results for the Heckman's 2-step approach and 2-stage least square results. For the left-hand side, the Heckman's 2-stage approach. In the first step, we use the logic model to estimate the probability of a firm having VC. And that's reported on the left-hand side of the table, the upper section, the panel A. That's the first stage regression reported there. When we try to address the endogeneity issue on the right-hand side by the two-stage least square model, we can use it to control for the reverse causality. And again, at the first stage, panel A, first stage equation, endogenous variables VC ownership is regarded upon instrumental variables, which is the VC number, along with the other exogenous variables. And the fitted values are saved. And on the next page, page 22, this is the enlarged version of the previous table. We just present the panel B of the table here. And in the second step, we include the lambda estimated from the first step regression on the left-hand side as the additional independent variable. And the second step result, which is shown in column A to column 4, column 1 to column 4, are consistent with the baseline regression model result in table 2. Okay, which is suggesting that the coefficient on VC dummy multiplied by Tobin skew are positive and significant, suggesting that the presence of VC enhancement on the firm's investment efficiency. And on the right-hand side, the original dependent variable, the investment total and adjusted investment, regress upon predicted value of exogenous regressors and exogenous variables. And the results are shown in column 5 to column 8 in panel B. And again, the results are consistent with the results in table 2. For example, the coefficients on VC ownership multiplied by Tobin skew are positive and significant, suggesting that VC ownership improves the portfolio's firm's investment efficiency. And up to this point, we have the robustness to check and show that they are consistent with our findings from the baseline regression model. On the next page, page 23, we have the alternative explanations. The financial constraint and financial developments. We basically focus on these two. The first issue is that we look at whether the financial constraint is important in terms of the efficiency and in terms of improving the efficiency. And the next is to look at the firm level financial constraint. We defined it as the Kaplan and Ziegler 1997. This is the same index. We are adopting the same approach to construct the index. And the next issue we look at is the financial development issue, to look at whether the provincial level marketization index, because we all know that the provincial economic development is quite different in this massive country. So we have to look at whether the differences, the measure of the process of marketization of each province in China. And it's constructed by including 5 indexes. Okay, the indexes will include the, for example, the relationship between the government and market, the development of non-state-owned economy, the development of product market, the development of factor market, the relationship between the intermediate organization development and legal system environment. So these are the factors we include into the marketization index to study whether these two factors are important as well. And on the next page, slide number 24, we reported the results of regarding to the financial constraint and financial developments. Our finding is that from our table 5, these main variables are all insignificant, which indicate that the portfolio firm's investment efficiency does not vary with the financial constraints and the local financial market development. All right, so this is another set of examination that we try to tailor when we are dealing with real-world circumstances in China. On the next page, page 25, we would like to ask the question, how does VC enhance the investment efficiency? Just like Victor have introduced in the literature review, we have the different views on the different mechanisms. For example, whether the agency cost issue is more important or the information asymmetry issue is more important. On the page number 26, so basically this we are repeating what we were talking about in the literature review session. The last point is the above discussion will lead us to the reduced information asymmetry and agency problems, and thus increasing the investment efficiency. So on the next page, we show that relationship. We believe that with the involvement of the venture capital, the mechanism is that the venture capital is affecting both the information asymmetry and the agency costs in two ways. And finally, we can observe their functions or what they can do in terms of the investment inefficiency, okay, to deal with the overinvestment or to deal with the underinvestment. Then on the next page, we look at the mediating role of the information asymmetry and the agency costs. To measure the mediating roles of information asymmetry and agency costs, we employ Barron and Kenny 1986 method to mediation, in which mediator is employed to mediate the relationship between the independent and dependent variables, and to explain the reasons for such a relationship to exist. So, so generally, we would like to determine the indirect effects of the independent variable on the dependent variables through the mediation variable. In order to do that, we have the two more variables and a couple of new equations. For example, we include the information factor, we include the agency variable. And for each of them, we introduce three definitions of them. For example, in the information, we adopted standard deviation of the analyst forecast, the T-RIX, which is the standard deviation of the daily stock return, and the analyst covering the firms. And the results is presented on the next page. Okay, the next page represents the results of the panel A. This is the result of the panel A, which we focus on the analyst as the mediating variable for information asymmetry, while all the three measures of agency costs are included. And in panel B, we focus on the T-RIX, and in panel C, we focus on the disper as the mediating variable for the information asymmetry. So in this table, column 1 and 8 show the correlation on the VC dummy and VC ownership are negative and significant, indicating the VC-backed firms are lower information asymmetry, which is consistent with the previous findings. And the significant and positive coefficient of the VC dummy and VC ownership, as well as the negative correlation of the analyst in column 3, 5, 7, 10, 12, 14, show that information asymmetry significantly reduce the corporate investment, while VCs are able to enhance their investment efficiency. All right. These are some basic findings from the panel A, panel B, and on page 30, it's the result for panel B. We find a similar result when T-RIX is presented in panel B, the results for T-RIX. And on panel C, the disper result is presented. These are used to measure the information asymmetry in panel B and panel C. And further, the column 2, 4, 6, 9, 11, 13 show that agency cost does not play mediating role on the relationship between VC and investment efficiency. And this can also conclude from the mediation relating statistics in panel A, B, and C. All right. The next page, page 31, is the table 6. Table 6 is for panel C, the disper and agency costs. So on page 32, the mediation role of the information asymmetry is presented. So as previously discussed, the information asymmetry leads to the underinvestment problem, and we will directly investigate the relationship between VC and underinvestment via the investment efficient asymmetry, information asymmetry. This table presents the estimation results regarding the mediating role of information asymmetry in the relationship between VC and underinvestment problems. Okay, and we found that the results suggest that VC-backed firms have lower information asymmetry, which is consistent with Davila 2003, and we also find out that the coefficient of all the information asymmetry measures are negative and significant, showing that the investment asymmetry increase the level of underinvestment. Okay. All right. From the table, we can also observe the direct effects via the information asymmetry and the indirect effect from the information asymmetry. Okay. And the total effects of the mediated effects on the last row of the table. Okay. These are the main findings from our regression sets, and we believe that we have a couple of findings from our study. For example, the initial or the basic findings are higher VC ownership increase the investment efficiency. And we also find out that VC-backed firms are associated with low underinvestments. The results in harmony with the monitoring view of VCs and confirm that institutional investors' involvement play a fundamental role in improving the firm's value. And that can be identified from our first couple of baseline regression results. And the impact of the VC on firms' investment efficiency does not vary with the firm's financial constraint, nor with the local financial market development. And these are the set of tests specifically for the Chinese market, when we believe that the market development is vary a lot, province by province. Okay, and also the financial constraints are important in terms of the investment, but we do not find the evidence to support that. We see evidence. We see enhance the portfolio firm efficiency via the direct effects of the information asymmetry on investment inefficiency, as well as the direct reducing of the underinvestments. And that's also the one of the main findings we believe for the study. So I think we are at the end of the presentation here. And Victor, please, if you would like to add anything.
No, absolutely fine. Thank you very much. I think you've gone through all the results. So thank you indeed, Xiaoming. What I will do now is to go back to the participants, the floor, and look at the comments and any questions. I see in the chat room, there are no comments in the chat room yet. There are a number of apologies. Yeah, there's one apology. Yeah. So maybe what we do is that we can take comments by show of hands. And indeed, Jun Hong Yang, you have a comment. Please go ahead, please, and unmute.
Hello, hi, can you hear me, yeah?
Yeah, we can hear you very well, thank you.
Thank you so much for your very interesting presentation. I think remind me, this paper is quite one of my paper, I think earlier published in the JCF about the efficiency of balancing act. I think we also look at from the financial constraints or also the agency problems, see how they are explain the investment efficiency. We also using the Richardson 2006 methodology, the way I think similar to what you do. I think a few comments. I think the first one, because you're using quite long time period of data. So I believe it's from 2003 to 2016, yeah?
Yeah.
So I think you have more than 15 years data, and you are saying in average there's a 2,000 more than 2,000 firms each year. So I don't know why your data is ended up with only 10,000 observations. So I don't know what kind of observation you are dropping from your regression. I think it's a big concern since you should supposed to have more data than currently you are presenting right now. I think another few things. Another one is about your main variable is venture back variable. Okay, it's a dummy and also the ownership. I think it's very important. You might also need to control for the other institutional ownership as well, because the venture back ownership is one of these other institutional ownership. So I don't know if you control for other things, saying the mutual fund or other things, how your result will be different. And other things about the, I think later on, you are trying to be capture the kind of agency problem, but I don't think your agency problem, the measurement is for me might be maybe something you can improve, because you are using the operating expenses, you're using the free cash flow, and using the if they are engaged in the takeover market. But from my point of view, I think these three variables is not very good to measure the agency problem in China. I think the majority agency problem in China is the majority shareholder was exploit minority shareholders' interest. So I don't think this free cash flow somehow we see is good, because free cash flow we see in China is more the way to support they are doing the investment. So somehow the kind of informal finance, we do not see this agency problem. Okay, I don't think it'll be similar as the Western saying. Also, for the information asymmetry, the one you are trying to measure, I think maybe it's better to, I don't know. I in one of my research, I was using the kind of spread, a spread between big ask. I think this is something we are using try to measure the kind of information asymmetric. But however, coming back to your argument saying the financial constraints not play important role here, but since but you also find actually information asymmetric something play quite important role. So somehow it's contradict to each other, because information asymmetric somehow will contribute to financial constraints, and this is one of the big issues in China. So I'm not sure if you can able to explain these things better. And also about your mediating result, it's quite difficult for me to see the result about your mediating things. But from based on my understanding about mediating, I think you should seeing if you seeing the information asymmetrics or agency problem play quite important role, then you probably will seeing your original variable about the kind of venture capital will be dropped somehow the significancy when they are putting in the regression of the kind of investment regressions. So I'm not sure because the result is presenting quite, I'm not sure it's maybe at the end it's quite rushed. So I'm not very getting how you are getting this kind of mediating effect. Okay, so this pretty much everything because it's quite close to my research, to be honest. So
I agree. In fact, Jiaotong, you are right. We have cited some of your papers, and I could see that you've been also working in a particular area. I thank you for those important, observations, and especially about your insight on the data, and also the comment you gave about controlling for institutional ownership of other forms other than venture capital, which is always a way of clearly identifying the very variable of our interest, and also the interpretation on a financial constraints, which again we can look at. There may be some of the measures used in your literature, in your paper, which some of the measures which are different from our own measures, and which we can use to show the robustness of the results. I don't know whether Kiong or Xiaoming would like to add to some of those observations, but yes, we thank you for those contributions. Xiaoming, do you want to add, or Kiong, you want to add?
Cheng, would you like to respond
on the data?
Yes.
Oh, sorry, I mute myself. I forgot I mute
go ahead,
myself.
Go ahead.
Yeah, about the observation, it was supposed to about more than 20,000, but because we got, first we exclude the financial institutions, and then there are lots of missing variables because we use the ownership data, and the ownership data only published from 2003, and some of the data are missing. And while we exclude all those missing data, it's we are left with about 10,000, more than 10,000, because we want to keep that all those data are at the same level. I mean, to keep that those data, they are at the same number of observations. So if there are a missing observation for one variable, we will drop all the variables for that particular day. So at last we only left with 10,000, about 10,000. Yeah.
So I found some regression. You only have 1,000 or 2,000 observations. I think it's pretty not very good, because consider you have more than 15 years of data. 2,000 observations, I do not see you are presenting quite overall the pictures about Chinese firms.
I see. Maybe I will check later to see if there are better ways to use to arrange about the data. Anyway, thank you for your comments. I will check again. Yeah.
But we are possibly talking about the same data sources as available. So again, a check on the data would be absolutely helpful.
Sure.
Thanks very much.
Thank you.
Regarding the institutional shareholders, I believe we look at the other institutional holders as well in other studies, in other research studies. Can you remember what's the reason we do not include the institutional investors here, Chung?
Yeah. Oh, about the institutional ownership. Yeah, because generally I reference to some of the venture capital literature, and I didn't saw any of the venture capital literature they include the institutional ownership as the control variable. But I think Professor Yang made a good point, because we are looking at the institutional investors' impact on the investment efficiency. So institutional ownership might be a good control variable. So I will check the literatures of Professor Yang's paper and also other related literature to see if we can add the institutional ownership. I think it's a good point.
And in particular, I think we would try to pay attention about mutual funds.
Yes, I think we discussed this issue before. I believe, if my memory is correct, I believe we discussed the other institutional investors before. But probably as you said, we checked the literature. Not a lot include that in their study. And also, I guess because we see they are kind of institutional investors as well. So it's more or less a kind of proxy for the institutional holdings in the portfolio firms as well. So even if we have the data, well, my imagination is that this two could be highly correlated. It's purely my imagination now. So we may
saying ownership, saying the state-owned firm or the kind of private ownership in your equation. I think it's also quite important when you are studying in the Chinese context.
Yes, in fact, in our other studies in venture capital, we do include ownerships, ownership characteristics as well. For example, the state-owned and the others. But because it's specifically for efficiency, and I believe that we had the discussion that not a lot of the past research include that information, and I believe that's one of the key reasons why we are not including them into our research. Chung, do you have anything to add?
Okay, can we take on? We have some further comments lined up, so let's extend the discussion and give opportunity to. There is Peter Muriu with the University of Nairobi. Peter, I can see your hand is up.
Yes. And thank you very much for Victor and Ding for this fascinating work. I must admit that too much effort has gone into producing such amount of work. Now, Ding, in your presentation, you gave a breakdown of the total investment as maintenance investment and new investments. And further on new investments, you talked about abnormal investments. I'm just curious on getting to know which are these abnormal investments. Thank you, Chair.
Thank you. Xiaoming? Xiaoming seems to be frozen. I think the investment variable that we have is normalized and adjusted for other forms of investment. In fact, I should say that the endogenous variable investment efficiency is adjusted for many factors, but we'll see how we can explain the. We're interested in the threshold of underinvestment and overinvestment, so we'll see how we can explain any departure from normality or abnormal investment, as you mentioned, Peter. Eli.
Yes.
Eli, yes, please go ahead. Yeah.
Well, congratulations for your presentation. It's a very good paper. I'm not a guy of finance, but I'm curious, so I'm going to ask you a quick question. Why do you use information asymmetry and agency cost as mediating variable instead of moderating variable? And very quickly, my second, I will just give you the second two questions right away so you can, take your time to answer them. The second one is, if you can elaborate a little bit about how you measure the investment efficiency.
Okay. Chiong?
Yeah. So we measure investment efficiency by we measure the investment inefficiency, because investment efficiency happens when there is no deviation from the expected level of investment. So we measure investment inefficiency by overinvestment and underinvestment. The overinvestment and underinvestment is the deviation from the expected level. So if the deviation is greater than 0, it will be overinvestment. and if it is less than 0, it is underinvestment. So actually, we measure the investment inefficiency. And about the mediating, we use the mediating rule of the information efficiency and the agency cost because we want to identify the mechanisms. How does VC to reduce the investment inefficiency? So the reason is that we want to look at the mechanisms. So the mechanism we identify is that we see reduced investment efficiency both directly and indirectly. The direct effect is that we see direct reduce the investment inefficiency, and the indirect way or the indirect effect is through the information asymmetry and the agency costs. So this is why we use the mediating rule, because we want to identify the exact mechanism, that is, how does we see reduce investment inefficiency and all to increase or enhance the investment efficiency.
Okay, thanks, Jiong, and thanks, Ellie, for that helpful comment. I think Kyung is referring to the chart that was on the slides answering the question of how on the transmission mechanism. Francois?
Thank you very much for this great presentation. My question is related to the way venture capitalists are selecting firms in which they invest, and also the way you are testing your first hypothesis. We know that venture capital fund receive money for from limited partner like pension fund or insurance company, and sometimes they require return from firm in which they invest. It is between 20% and 30%. So basically, they select firm with high potential value and high expected return. So it's like some kind of bias selection bias in the way venture capitalists are investing. I'm just wondering if you were able to control this fact, this kind of bias selection, because there is another bias selection you control, if my understanding were correct, linking to the selection bias, sample selection bias.
Thank you. Yeah.
Yes, thank you for your question. Yeah, actually, we concern about this problem, and that's why we use the two-stage least square regression, and we employ a instrumental variable, which is the number of venture capitals in a given province. So the number of venture capital. It's a reasonable variable for instrumental variable to control the endogeneity issue here, because we expect that as the number of venture capital in a given province increase, then the number of venture capital backed IPO firms will increase. So, but a firm's investment efficiency is unlikely to affect the number of venture capital. So this is why we think the the number of venture capital in a given province is a reasonable instrumental variable. And yes, we indeed consider or take into account of this endogeneity issue.
Thank you.
Yeah, thank you.
Thanks, Kyung, and thanks, Francois. For this question in particular, it is reflecting some of the same challenges we have in some of our own investigations on selection bias and endogeneity. Pascali. Yeah.
Yes, thank you very much for a very interesting paper and for a very, very thorough presentation and discussion. I only have a few small questions. about the specification of the investment equation in your analysis. No. Well, the Q ratio, the Q value that you introduce in your equation, it is statistically significant and positive, but the absolute value is quite small, and so that would denote a very slow process of adjustment to equilibrium investment. And I was wondering whether you have also considered alternative specification of the investment equation. I mean, the Q ratio itself may be endogenous, so you may try to correct for the endogeneity of the Q ratio with respect to investment. But it seems to me that in most of the equations, the really basic static equations, you have some lagged explanatory variables, but maybe you could also consider the lag-dependent variable investment itself lagged, also considering that there is a lot of inertia in investment decisions. And maybe you could just go away and try and estimate Euler equations for investment, which are not fully dynamic equations. And yes, related to the sample selection bias by venture capitalists, now you have estimated the Heckman correction, but in your tables, you not present diagnostics on the Heckman equations. I'm sure you have them. I wonder whether you can comment on the statistical significance of the Heckman corrections, the inverse Mills ratio, and or the like. Okay, thank you.
Yeah, thank you, Pascali, for those observations and further insights. In particular, I like your comment about exploring the inertia in the specifications, which is straightforward to implement with a lag-dependent variable, and indeed we'll see. I think after so many regressions produced, we need to check to see whether we had that and whether it did produce any insight or much more clear results. And of course, also the comment, actually very useful comment on a plausible alternative specifications involving the Q ratio. Perhaps on the diagnostics of Heckman, I will see whether Kyong or Xiaoming have any answer to that comment.
Sorry, I just lost. What's the question about the Heckman?
The question is that Pascal, I think, which is something very important, that whether we could explicitly report the diagnostic results from the Heckman. I think they must be there in the results, we look at them and include them in the table for discussion. But I think it's very important because reviewers would be looking for those test diagnostics as to whether the Heckman procedure was correctly implemented and validated. Which we
had done the diagnostic test. Yeah, we had done that, and in the table I only report the inverse mu ratio. That's the lambda.
That's right. The investment. Thank you very much, and thanks Pascali. So we have in order we take Christine, and then Eri. You may want to come again. I think you have your hand up, or that's an old hand. And then Hongbo. Okay, so so it is Christine and then Hongbo. Christine.
Hi, thank you, and thank you, Jiaotong, Victor, and Xiaoming for an interesting paper. My question is not on the statistics; it's more on the interpretation of the theoretical model and the interpretation, because it's very much grounded in the finance literature. But there is another venture capital literature that's more closely aligned with the management literature. And it's true that they would also see, I mean, obviously venture capital can fill a finance gap, so that would be consistent with both literatures. And also venture capitalists tend to close down information asymmetries because they only invest in industries where they have got some experience and knowledge. They tend to be very idiosyncratic. But the other thing they do is that they fill a management gap. So the finance models tend to assume that management is perfect. It's just an asymmetric information problem between management and investors. Whereas the management literature sees management capabilities as a variable that needs to be explained alongside other things. And the venture capitalists, because they're investing in areas where they have significant expertise, they may have run their own business in that area and retired. And now they want to engage in risky projects because they know the risk, they understand the risk because it's an area where they've got a lot of knowledge. What's really driving the positive result, or what could also be driving the positive result on venture capitalists and the efficiency of investment, is that they are improving management capabilities. I don't know whether you can incorporate that in this model, or whether you could at least
absolutely. I think
that's an alternative explanation. In addition, it wouldn't be in contradiction with any of those other things, but it would put a different complexion on the discussion of your results and the theoretical framework.
Thanks, Christine, for that constructive suggestion. In fact, on the slides when I was reviewing the literature, I did refer to the fact that venture capital would sit on the management board, on the board of directors, and also be actively involved. What I like about your intervention and constructive suggestion is that we can also root it in the management literature, and we will look into this. And maybe, so the theoretical construct will be just trying to get the finance literature review, but also fuse it, what you called a management gap context of the management literature. So that's very helpful, and we can, it can enhance the way we explain the theory behind the models and the results, and especially on the how question that we try to show the channels of underinvestment and overinvestment. Thank you very much. Much appreciated.
Also possibly include variables on management capabilities, because that's what's missing in the model.
I'm sure that you have a reference that we can hold on. If you just sing it in an email, that would be appreciated if you remember it. I said one of the theoretical, tractable theoretical explanations in management literature. I'm sure that Eli would be thinking about the same in his guru as a management person. But thanks, Christine, for bringing that dimensions, the cross-fertilization of ideas that works. Absolutely grateful. Okay, Hongbo.
Yes, hi, thank you. So thanks for the presentation, and you can imagine how the extent to which I like the paper, because it is very close to my own research as well. So I have we have talked about a lot of details. So let me talk about the hypothesis, the theoretical background. So if I can summarize, I would like to see a little bit more Chinese rather than general thing. So your hypotheses are basically established based on the general prediction of venture capital in their portfolio firms. So my question is, what are the differences between Chinese VC capitalists as compared to, VC capitalists that invest in mature market economies? So one of my PhD students, actually, she has finished and she worked on the Chinese PE market. So we found out actually Chinese VC capitalists, they very often, they are short-term, they have a short-term horizon in firm. So that means that they do not pay attention to governance, to management, but they just follow the firm, invest in the firm, and then put the firm through the IPO process, and then they exit. Okay, so the question is, so there is a literature now, people are talking about the short-term horizon of Chinese PE investors, or including VC. And another piece of information that is relevant is a lot of, quite a few papers, they already said Chinese VCs, they invest in the later stage, and then after IPO, they call themselves actually PE investors rather than VC. So your sample covers quite a long period. So I wonder, who are those VC investors in your sample? Are they institutional, which I doubt because they are mainly very rich, wealthy individual investors? And some of them were maybe connected to the government. So I would like to see more Chinese rather than general. So that's something that I didn't see from the hypothesis. And we do have a paper which found that if you check the long-term performance of PE investors in their portfolio firms, for example, and there is no positive long-term impact. So that's my question. So what are those VC investors? Are they the same as what is predicted by the standard VC or PE theories? Okay, so that's something. And in addition to that, I think, yes, I think maybe Junhong mentioned that I did find something very confusing. So you run a regression to check whether or not regional financial development and the firm's financial constraints are relevant to the VC's impact, and you said that they are not relevant. However, you did find something saying that one of the channels that we see positively affect the firm investment is through asymmetric information. But if financial constraint is not relevant, financial development is not relevant, how can I accept that one of the channels through which we see affects firms is asymmetric information? So they should be consistent. At the moment, and you are not consistent if I put those two regressions or the results together. So if you do not need that regional, financial development, etc., you can take them out. Otherwise, they have to be consistent with your VC-related estimation. So the final thing maybe I can say is that your investment efficiency, which I do not know whether or not the deviation of the firm's investment from the expected level is a good thing or bad thing for the firm. So either you can do a little bit more to convince people, yes, the larger the gap, the more inefficiency, as you argue, but it is not guaranteed. So you need to check what exactly you mean by investment efficiency. So I think I have something more, but that's okay. Yes.
Yeah. Thank you very much, Hong, and very grateful for your comments. I know you work in these areas, and I think we have cited some of your paper in the references for this work. You make actually very constructive, suggestions, all of them, for example, reflecting China's peculiarity would be important. And I think for example, in the formulation of hypotheses 1, 2, 3, we could capture in and reflect some of the intrinsic characteristics of China's VC and make the hypothesis bite or reflect, consistent in alignment with the objective to look at VCs in China. And also, you did mention a very important observation, and I think that reflects also the comment that Junhong was making about our interpretation on financial constraints and the information asymmetry. And basically going back to Fazari's, old work, other people have done it, Bob Chirinko has, taken it an extra mile. So we'll have, another look at that. And also, I think the third thing I picked up, the third point was about the measure of investment efficiency. And I think theoretical grounding and how then we interpret the results would be, helpful. I don't know whether, Xiaoming wants to add or Kiyonga wants to add on this, but, I thank you, Hong, for those constructive suggestions. I think the, go ahead.
Sorry to interrupt. Yeah, sorry. Thank you, Professor Bohr, for your constructive comments. And regarding to the period, the holding period of venture capital, actually in China, there is a lockup period after IPO. So at least the venture capital has to hold the ownership for 1 year at least. And actually in our sample, the average holding period is about 3 years. So the second comments regarding to the type of venture capital, actually in our sample, they are all institutional investors. The individual venture capital or the angel investor are excluded from our sample. So all the sample are institutional investor. And the third one regarding to the financial development and the about the financial development and the concentrates. Actually, the purpose here, we investigate the impact of financial development and the financial constraints here is to, because we interpret the positive relationship between venture capital and investment efficiency as the monetary function played by venture capital. But we think, or it might be argued that the relationship or this happens because the venture capital backed firms might have better access to capital, both at firm level or province level. So for the firm level, it's the financial concentrates, and for the province level, it's the financial development of the province. So this is why we investigate the financial concentrates at firm level and the financial development level, because we want to make sure that the venture capital, the venture-backed firms have, have better investment efficiency. It's not because the firm have better access to capital. And the results show that venture capital enhance investment efficiency, not because the firm itself have better access to capital. So this is why we investigate this issue. And about the deviation from the expected level to measure over investment and under investment. I think I understand why you're concerned, and actually this is kind of common measure from the investment efficiency literature. That's from the Richardson to 2009, and generally most of all, it's common to use this measure from Richardson to measure the investment efficiency. Yeah. Thank you for your comments. So hope I hope I give you some.
Let me just respond one thing. So you mentioned the investment efficiency, right? So in your equation, you have not controlled the other variables that are relevant to your investment. Imagine I set up a target last year, but this year COVID-19 took place, so I have to change my investment in order to respond to the changing environment. So that's the reason why I'm thinking maybe efficiency is not necessarily real efficiency. It's you need to control other variables if you really take this measure. So macro level, industrial level, etc., etc. So that's what I meant. So maybe it's good to check.
Okay. Oh, I get it. Yeah, thank you. I get it. I will check literature. Yeah, thank you.
Thank you.
Thank you very much, Hong. Thank you much. Appreciated. We're just on remaining with about 5 minutes before we close. Eddie, your hand is still up. Is that an old hand or you have a new question?
No. It's a mistake. I don't have any question.
Okay, all right. It's an old hand. Thank you very much. So I don't see any other hand up, and we've got very general. Oh yes, Wanja Douglas. Let's say, I think, University of Nairobi.
Yes, yes, thank you, everyone. I think mine is not to delve into the technical bit of the VC and the like. It's just to appreciate the team and everyone who has done this a commendable job. Some of us are doing our PhD, so we are really learning a lot. So thank you so much, and this is very great work.
Excellent, Douglas Wanja. Thank you very much for these lovely comments, and please keep coming to our weekly sessions. So I think
to join.
Yeah, excellent. So let me thank all those people who come from all over the world and actively participated in this meeting. It's the first meeting where we are running up the close of time. We normally finish a little bit earlier sometimes, but this is, I think, the excitement and the of this work. And so thank you very much indeed. And we look forward to more discussion next week. We will give you a highlight, a blurb of the topics and the speaker by Friday, so that you can set time and come and join us and to be in this kind of discussion. Thank you indeed. Absolutely productive. And let me wish you a good evening. Some of them maybe China is close to midnight. Good night. So thank you indeed. We see you next week. Thank you.